the amount of risk sentiment that is prevalent in the market, how much risk is someone willing to take, and also the M2 growth or decline, right? Which is basically liquidity. So it's risk and liquidity. That's the two things. How much risk is someone willing to take? How much money is, flowing around the system? Is it increasing or decreasing? And one of the greatest ways to determine the risk sentiment, how much risk people are willing to take, is to look at the stock indexes in the US. So you can see here that the stock index for the S&P, so the S&P 500, I'm pretty sure, yep, is near all-time highs, right? Here's the high, almost at all-time highs. If the S&P 500 is above the all-time high and going like this is priced in a territory it's never gone before. This is a reflection of how strong the economy is, and people get excited, they get confident, and they get happy about all the money they're making, and this confidence, this sort of risk sentiment ends up manifesting itself in the investments decisions that people make. So let's say stocks are at all-time highs, everyone's happy. This is when people come into crypto, because people are making money, they're all happy, the economy's going great, they want to get exposure to crypto. When the economy is dying down here, right, in October 2022, remember the bottom was at like December 2022, like here, this is like the bottom for crypto. When stocks are dying, everyone's panicking, the sentiment is risk off, people are selling their riskiest asset, crypto, and that's why it goes down. Okay, so you want to use basically the stock index just to tell you what the risk sentiment is at the moment. And last but not least, inflation data. So we talked about inflation before. I've already showed you this. When inflation is really high, the Federal Reserve wants to lower it to 2%. When inflation is below 2%, the Federal Reserve wants to raise it to get it to 2%. Generally speaking, the best position to be in is that the economy is slowing and the Federal Reserve wants to provide support for the economy. That is what has created the prior bull runs. What you don't want to see is the economy overheating, because the Federal Reserve will be pulling back, pulling on the brakes. And the first thing to sell off, the first thing to dump, the thing that dumps the most when the Federal Reserve pulls on the brakes is crypto. Okay? So now that we've done that, you understand that crypto is a risk and liquidity driven asset class. Right? Here's a table showing you the risk and the reward for holding certain investments. Safest thing is cash, it doesn't make you money. Bonds, you get 5% a year, near zero risk. You can buy property, 10% a year, but you obviously have some risk. Stock markets, same sort of thing, emerging stock markets. And then crypto, highest risk, highest reward. In just markets in general, when the market is panicking, the riskiest thing gets sold off first. So in a risk-off environment, money moves down the risk curve, or I guess the risk line. And when there is an increase in risk sentiment, when things are going great, people tend to take more and more risk. So they move their money from cash to crypto, or from bonds to crypto, or from cash to property. That's what they tend to do, right? And it's this cycle. Money goes up here, and then it comes down here, and it's just this endless cycle, right? And you can see here the risk and return of all these different asset classes, right? Let's make myself smaller. You can see here that this is showing you what's the bottom thing? I actually don't know. Let's just assume risk and reward, right? Inflation rate. This is the minimum amount of money you have to make to beat inflation. So real returns, not nominal returns. Real returns is like money is profit after inflation. Nominal returns is profit before inflation. If you don't make money after inflation, then you make a nominal return, but that's not important. You need to make more than inflation if you want to make money. So you can see here that China massively underperformed, and I think in terms of risk, it's all the way over here. I don't know how they're measuring any of this side data, but see if there's crypto here. Crypto isn't on this, but crypto would be a very high returning asset class, so it would probably be like off the charts, right? I mean, this is just to show you that the safest investments tend to not make you much money, and the riskiest investments tend to make you the most money, but they carry the most risk, right? And you can see there's a curve here, right? As you take more risk along this curve, it curves up. It's not a great explanation, but it's just to show you in a general sense, not getting too nerdy or fancy with it, that S&P 500, more risk, more reward. You know, you hold US dollars, you know, you're not making any money, but there's less risk, okay? So there's a sliding scale of high risk to low risk investments. We just went over this, right? There's a scale, right? A sliding scale. During times of panic fear, when the market declines, the economy enters a recession. The first assets to get sold are the riskiest, right? Because people go from the risky shit to the safe shit when the economy is going shit. This is called a flight to safety. When markets are booming, people want to try and capture returns on their money. They tend to move out on the risk curve, so they go from gold to stocks, like we said before. You know, cash, gold to crypto when they want to take risk, and they go back when they want to pull off risk, okay? When markets are booming, people want to try and capture returns on their money, blah, blah, blah. In crypto, this also happens too. So in a bear market, right, the dominance of Bitcoin goes up. I think I can show you this on a chart. In bear markets, right, think about where the bottom was for the market. It was November, December, right? At the beginning, well, I guess it's more the beginning of the bull run, but after the market has crashed and people have lost all this money, they tend to want to reconsolidate their portfolio in Bitcoin, right? They want to move to safety. And when crypto is booming and the market is going amazing, we have what's called alt season, where people move from Bitcoin during the bull run to altcoins, and the dominance of Bitcoin of the overall market declines, right? Bitcoin is 50% of crypto right now. Maybe in this alt season it might go to 20, 30, 40%, sorry. Maybe it goes lower. But that's just to show you that Bitcoin the safer thing, altcoins the risky thing. When people are scared, they go to the safe thing. When people are confident, they go to the risky thing. How macro affects markets. So again, as we said, macro is the main factors of macro is risk, sentiment, and liquidity. When risk is off and the liquidity is declining, right here, liquidity declining, or you know, interest rates climbing, or inflation high, whatever it is, crypto dies. When there is risk on sentiment and increasing liquidity, crypto pumps. The desire for risk is determined by the backdrop of the global economy. You can see here the emotions that drive decisions. The macro backdrop which creates these emotions is different each time. So during 2020, the crash was caused by COVID. 2008, banking crisis. You know, the recent crash in like 2022 is you know, rapid inflation. There was massive Ukraine wars, all this bullshit, right? But macro is not a predictive tool necessarily for knowing where to buy and sell. So if you look at macro data all day, you're going to see that at the bottom of the market, there's the most amount of bad macro news, right? Ukraine war, rampant inflation, stocks crashing, all this shit, right? So if you use the macro data too much and you don't use it correctly, you're going to not buy the bottom. You're going to be most scared at the bottom because the macro is the worst at the bottom. But what I do use macro for is it's basically a guiding compass for where the overarching trend is heading, to be used as confluence with other crypto-specific data. So I would never buy because of something macro-related or sell because of something macro-related. I would factor it in with all this other data that I look at to make a decision. It's used in confluence, okay? Because macro is very macro. You can't make micro decisions like a buy or a sell using highly macro data where it's more like guiding your overall portfolio or the overall direction you think the market's heading. And if you use macro data wrong, if you try to use it to buy bottoms and sell tops, or you use it to like, you know, decide what to do, you're going to end up missing the bottom. So most people have missed the Bitcoin and crypto bull run because they were all worried about macro. Oh, inflation's really high. The Federal Reserve hasn't pivoted and started cutting interest rates. All this shit, right? You know, they're all waiting for the liquidity to come back, right? We talk about this liquidity tool. They're waiting for it to get up to here, right? Dummies. Oh, what have I done here? I've made this look shit. Reset soon. That's better. Okay. Everybody learned a lot of macro in 2022, right? Because they've started hiking interest rates. Inflation was really high. They learned a lot about macro because prices crashed because of that. Now it is time to unlearn it. 2023 will be a year for bargain hunters, not for macro traders. Okay? Now what am I trying to say here? Markets are forward-looking. So when you're using macro data, it only gives you an edge when you can use the macro data to cast forward what you think the data is going to do in the future. If the economy sucks today, everyone has bought or sold knowing that information. And they don't decide what to do tomorrow based off what happened yesterday. They decide to do what to do tomorrow based off what happens in the future. So if you're trying to make money in markets, you have to understand markets are forward-looking. You have to guess what's going to happen in the future, because what happens next week is going to determine what people do next week, right? So if you know everyone's going to buy next week, you buy today, so that when they buy next week, you sell to them at a higher price, right? That's sort of how it works. And so what happened was everyone was looking at the macro, the economy was shit, inflation, prices were crashing, they all thought the macro was a great tool. Now they need to understand that the market has bottomed, and just because everything looks like it's shit doesn't mean you shouldn't buy, right? 95% of the macro shocks are behind. So what was basically happening at the last bottom was all this panic around all this macro stuff, right? Inflation was the biggest scare. People thought that inflation was going to be like what we saw in the Roaring 20s. Like inflation was just never going to come down, and everything was just going to collapse, sort of. We had all this time. We got to take years and years to recover from the stimulus from COVID. We can't just keep printing, blah blah blah, all this bullshit, right? But what people didn't realize is that all the macro shocks were behind us, or most of them. Things can't really get worse from here. We've hit peak fear. We've hit peak macro bearishness. And so you can use macro to sort of counter trade, right? If the macro looks terrible, you can counter trade it and buy because it's probably near the bottom, and vice versa, right? So again, this is just to re-emphasize what we talked about. The single biggest novice mistake in investing is using current macro data to invest. Saying, oh, the economy's bad, I can't buy. I can't buy because, oh, the economy sucks. We're in a recession, I can't buy stocks. Are you an idiot? You can buy stocks in a recession. In fact, you should be. Because the market looks ahead 12 to 18 months. So if you think we're in a recession for the next 4 years, you shouldn't be buying crypto maybe for 1 to 2 years. If you think we're in a recession now, but in 18 months there's a solid chance we're not in a recession anymore, then you probably should be buying today or very soon, right? At when it's the next asymmetric upside opportunity. And look, I want to give you an example of a very, famous guy using macro data to tell you not to buy Bitcoin before the market went on a huge rally. He said, hey bro, inflation is ticking up again, credit debt is maxed out, people can't afford to eat, and World War III is starting. I want to buy my 25k Bitcoin bags. It's really bullish and totally going higher. So basically what Alex Becker doesn't understand here is that markets are forward looking, and all this bad shit that he's talking about has sort of already happened, and markets can't really get worse from here because we've already experienced that inflection point of capitulation, of max fear. You would need something completely and utterly devastating for that prediction to come true, which is a very, very, very low chance scenario, and you're better off betting on a higher chance scenario where it has asymmetric upside, which is buying because you think the market is at a peak point of fear. Okay? Sorry I'm talking fast, but there's a lot to cover here. So yeah, you don't want to fall into the trap of this idiot Becker. Great business guy, but he sucks at investing. You don't want to become a macro bear. Common trap most macro guys fall into is they, believe the state of the economy today is important for today's investments, which isn't true. You should be investing for what you think is going to happen in 1 to 2 years from now. The worst economy is the best time to buy. Bull markets always also climb a wall of worry. So, the Bitcoin got to 18K. It's now at 25K here. It's now at 40. What's it at now? 43? Yeah, it's at 43, 44. The market has been going up because it's been climbing a wall of worry. That's sort of how bull runs work. So yeah, during a bull run, there's always going to be something bad going on. There's always going to be some sort of story or macro event that makes you want to sell. But that's just the wall of worry. Those expecting a huge crash simply don't understand the role of inflation in minimizing the downside of investments, right? Because what happens is the denominator, right, US dollar, has been massively inflated compared to what price was 10 to 20 years ago. So you can see here, first let's cover the wall of worry. Markets from this period here to here is basically only up with some brief, 1 to 2 year periods of down, but the general trend's up. Look at all the bad shit that happened along the way. All this is bad news events: bankruptcy, presidential election, Fed rate hike, Syrian tensions,